Okay, well, we think that the price in the short term, we could see a little bit of weakness in the price. I think currently trading at around 1180. I think we could see prices perhaps drift lower in the summer months, probably to maybe the low 1100, so maybe 1125, 1120 on the low side. We're expecting that the interest rate hike will come in sort of July-August period this year, but we don't think that'll have a big impact on the price at all, given that it's already pretty much factored into the price at this stage. Towards the end of the year, we think prices will start to move a little bit higher, and we could see prices, closer to higher 1200s, closer to 1300 by the end of the year. And that should also move into 2016 and 17, where we see gold prices edging higher over that period. I wouldn't think so. I think it's certainly not on our radar. I think you'd need to have some kind of stimulus or some kind of event in the world to actually push that higher. I think these days the economies have certainly settled down, and primarily the US market, which is where most people are taking their drivers from, the US is back into a growth phase, and I think that's one reason why we have seen such strong liquidation from ETF over the last couple of years, is because the Western investors are moving out to other asset classes. So I think, even in 2 or 3, 4 or 5 years, I think gold will probably be still retained in that sort of below $1,350, $1,400 range. It's certainly an issue for miners. That's the average all-in cost is over $1,300. It's like $1,317, I think our number was last year. It's making it very hard for Western producers particularly. A lot of the South American and Chinese producers can do it much less than that, have much lower costs, and so they are far more sustainable at those costs. But it's really the high-cost miners, so South Africa springs to mind, at very high cost of mining. At the moment we are sort of replacing reserves. So this was the last year. 2014 was the last year of growth within the mining sector. We expect to see that decline this year, albeit very modestly, and probably start to edge lower over the next few years. And I think part of that is the fact that money that was spent sort of 5 or 6 years ago when prices were higher, it's only just been delivered into market perhaps last year and the year before. So as there's less money being spent on greenfields exploration, we'd expect that to have a declining trend in mine production. So in terms of prices, I think there will have to be more hedging coming into the market, albeit producers are very reluctant to do so, but there may be part of that. They'll have to start to hedge as part of their financial arrangements. Yes, but at the same time, as prices say to move higher, we might see more scrap come into the market, so it'll probably be offset. So you have lower mine production, but then scrap might start to rise as prices move higher. So we tend to see supply being relatively stable.